Hello, welcome to the first video of Possibility Unboxed. Today I'm sharing about Sheng Siong, a dividend growth stock listed in SGX. Before we jump into the detail, a quick reminder. This video is meant for educational and entertaining purposes. Nothing in this video is intended to be financial advice. Please do your own research and consult a professional before making any investment decision. First, a quick intro on dividend growth stocks. Here are the key traits. Long track record of growing revenue, profit, and cash flow. Well-established company with a history of dividend payment. Financially healthy with strong balance sheets. Two things to observe. One is their ability to keep growing. Two, they generate more cash than they need for their operations and expansion that they can afford to give and increase their dividend. Some examples of dividend growth stocks include Coke, McDonald's, Starbucks, and Visa. Over 10 years, they achieve a total return ranging from 100% to more than 450%. For reference, over the same period, S&P 500 index increased more than 160%. Capital gain form the chunk of their returns. Yes, they are still growing. Assuming we bought the share at the beginning of January 2013, their dividend yield for that year were quite pathetic, from less than 1% to 3.4%. However, this company keep increasing their dividends, so if we held on to the shares bought in 2013, the dividend yield in 2022 would range between 4 to 7%. Their 10-year compounded annual growth rate for their dividends per share range from 5% to a high of 18%. Yes, I double-checked the numbers. Well, let's see how Sheng Siong compared to these well-known and well-established dividend growth stocks. 10 years returns were almost 280%, capital gains was 200+%, 10-year CAGR for their DPS was 8.6% thanks to the bump up from COVID. The share bought in 2013 will enjoy a dividend yield of 12% in 2022. Quite a good performance for a SGX listed company. Now, a quick intro about Sheng Siong. It was established in 1985, listed in 2011. One of the largest supermarket chain in Singapore with a revenue of 1.3 billion for 2022. Market cap is more than 2.3 billion. 69 stores in Singapore, mostly located in HDB estates, and 5 in China. It is founded, still managed, and majority owned by 3 brothers with a total stake of 48%. Since its listing in 2011, revenue, profit, and free cash flow has been growing steadily with a good bump during COVID. Their margin has been increasing, growing their profit at a faster pace than revenue. Over the 11 years, its gross margin grew from 22% in 2011 to 29% in 2022. Operating margin from 6% to 12%. The operative word for its performance is consistency, the ability to grow its revenue and margin year on year over so many years. The growing revenues and margin are a sign of its growing mood due to better brand recognition, more loyal customer base, selling more house brand, and having more bargaining power with its supplier. Next, we look at how Sheng Siong compared to its competitor. FairPrice is the market leader in Singapore with 370 outlets ranging from big supermarket to convenience store. They are a good comparison to Sheng Siong because they also focus on grocery in the Singapore market. Notice that their revenue trend is quite similar to Sheng Siong. They have been depleting their cash. Operating and net income went negative in 2022. They are aggressive into expansion and online shopping. They have been branching into other businesses like Kopitiam and absorbing other NTUC entities like NTUC Link and NTUC Food Fair into the FairPrice group. We have to watch how this acquisition will translate to future growth. DFI Retail Group was previously known as Dairy Farm. They are a leading pan-Asia retailer with more than 10,000 outlets from big supermarket to convenience store. In Singapore, they operate Cold Storage, Giant, 7-Eleven, and Guardian. Their revenue performance paint a different picture. They stopped reporting their gross profit a few years ago. Unlike Sheng Siong, their revenue and profit turned negative during COVID. As we compare them, Sheng Siong revenue growth is quite similar to FairPrice but at a much faster rate. DFI growth declined in 2019 and worsened during COVID. Their gross margin has been converging around 30% in recent years. Notice something. Sheng Siong operating margin has been inching higher while FairPrice and DFI has been trending downwards. A quick 5-year comparison in a table, notice Sheng Siong revenue and profit growth are much higher. It is catching up fast with its competitor. FairPrice and DFI ROE and ROIC has been lower and trending lower over the years while Sheng Siong has consistently been higher. This is another sign of Sheng Siong mood. By comparing to its competitor, we can assess whether there's a circular tailwind that blows everyone in the same direction. Revenue growth pattern of FairPrice and Sheng Siong are quite similar. However, Sheng Siong has been able to grow its revenue faster, achieve higher margin and has been a better capital allocator. Sheng Siong is doing better than its competitor. There's something we need to keep a lookout for with FairPrice and DFI. Are they sacrificing short-term profit to invest in the future, or are they having some issue? Here we look at Sheng Siong's ability to sustain its dividends. Dividend per share has been increasing steadily. Dividend payout is declining. This is good as net income is growing faster than the increase in dividend. Its free cash flow has been growing. It has zero debt with a huge cash position. This allowed them to invest in the business without affecting the dividend payout. So, what is the investment thesis for Sheng Siong? Investors have some concern. Many feel that the Singapore market is saturated and it has reached its peak, especially after COVID. There's little headroom to grow. More people are shopping their grocery online. Will Sheng Siong be disrupted like other traditional businesses? Remember the 2013 population white paper? It was projected that Singapore population would grow to 6.9 million by 2030. The population has been growing, though not as high as its 2020 projection. Household income has been rising steadily. Population growth together with the rise in household income has been helping Sheng Siong to grow, and they will continue to fuel its growth. How will they continue to grow? More new stores in Singapore, more revenue per store, online shopping, their expansion into China. The first two are something that they have been doing very well, so let's dive into the third and fourth growth engine. A question was asked on online grocery shopping for their AGM early this year. Online shopping contribute about 1% of their total revenue. They are facing high operating costs. They are learning by doing small. Long-term profit sustainability is important to them. No, they are not interested in doing it big because other people are doing it. On the question about their China business, it is still small, less than 3% of total revenue. Again, they take a cautious approach. They want to ensure that the team and the businesses are good enough before scaling up. It will not be a case of growing fast and big without a good foundation. On their growing cash position, they are preserving their cash to invest for growth. In a recent report by CIMB, where they host Sheng Siong CEO and CFO, they emphasize their intention to maintain their dividend payout. This is to preserve cash to secure land and construct a new distribution center in Singapore. This will be 3 times the current capacity, a huge capex item as their existing distribution center built 12 years ago cost them 70 million. It is currently trading around 153. This gives a trailing 12-month PE of 17.5 times. Dividend yield 4%. Next, we use a reverse DCF model. We assume 10% discount rate and 3% terminal growth rate. We use the last 12-month free cash flow of 155 million. This gives an implied growth rate of 3.2%. What this means is that at a share price of 153, the market assumes that Sheng Siong will grow 3.2% for the next 10 years. For context, its free cash flow has been growing at a much faster rate. We have the weekly price chart here. After rallying hard and hitting the all-time high of 185 in August 2020, it has been consolidating for more than 3 years. It is currently at support at 151. The next support is 144. Since listing, notice the share price has been well supported by the 200 weeks moving average, the orange line. It is currently at support. Will this be the low and bounce back, or will it break the support for the first time? To conclude, Sheng Siong is a focused and consistent grower. They do what they have been doing right, repeat the playbook and expand. The business has been generating good cash flow and building a strong cash position. We need to see how they will use the cash to continue to grow the business and reward the shareholders. The operative word they often use are prudent, cautious, and sustainable business. It has been and will be their approach to doing business. It is operating in a stable and defensive sector, mainly in Singapore, so not so much to worry about. It has been a better company compared to its competitor, able to grow faster with a better profit margin and a more efficient capital allocator. There are a few things to keep a lookout for as we validate the investment thesis. They continue to do better than competitors. Gross and operating margin continue to be high. ROE and ROIC to remain high. They make good progress on their online shopping and their China business. The three brother founders who have been operating the business are in their 60s. There's no mention of a succession plan. This is a potential risk to keep in mind. That's all I have for my first video. Hope you find it useful. Do subscribe, like and share. Do comment on your perspective and area to improve. Thanks for watching.